Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, we're going to analyze the Golden Butterfly portfolio. Yes, that is a butterfly and I am proud of it. It looks pretty good, in my opinion. This is actually a hybrid to Ray Dalio's all-weather portfolio, which I reviewed earlier this year on this channel. This will be similar to my other videos dissecting the lazy portfolio, aka the 3-fund portfolio. If you haven't seen that video, you can check it out right here. And this is actually a lazy portfolio in and of itself, given your risk tolerance. So here's a clue. This is a very risk-averse portfolio, and 60% of it contains investments that I probably wouldn't recommend investing in today, given the current macro environment. However, as investors, we must keep an open mind and be open to hearing all different types of portfolios and seeing different types of investment philosophies in order to stay sharp. So in this video, I'm going to explain what the Golden portfolio is, the Golden Butterfly portfolio, what assets it contains, and some of its past performance, which I think you'll actually be slightly surprised by. Okay, so what is the Golden Butterfly portfolio? The Golden Butterfly portfolio was created by Tyler of PortfolioCharts.com. This is a website that breaks down different types of popular investment portfolios and gives them a long-term backtest, which we're gonna do later in this video as well on my own. But this portfolio would be considered a medium risk portfolio as it contains essentially 40% stocks, 40% bonds, and 20% gold. So hold on, I know what some of you are thinking and some of you are ready to probably click off of this video right now based on what I just said, but I think it would be beneficial to you to watch the whole video and see the back-tested results, and I will also provide you with all of these investment ticker symbols so you can check these investments out for yourself. So let's break this portfolio down. So this circle right here, these are 20% pieces. I know all of them are not equal, I'm just hand drawing this, but 20%, as I mentioned, is dedicated to gold, which I will talk about in depth later in this video. 20% is the total stock market. Okay, so I'll just put total right here. 20% is small cap value. And we'll talk about that later in the video. This is actually very underrated, underappreciated. 20% is long-term bonds or treasuries. And then 20% is short-term bonds or treasuries, okay? So, gold, bonds. Who is this portfolio for? Senior citizens? Do you want some vanilla pudding with this portfolio? Well, let's break this down. I like that he included the total stock market as part of this portfolio. I'm a big fan of ticker symbols such as VTI or VTSAX, which would get you this exposure through Vanguard with a very low expense ratio. These ticker symbols get you exposure to the entire stock market and should be a staple in any portfolio if you're into ETFs, in my humble opinion. So VTI, for example, has over 4,100 different stocks that it invests in, which are weighted by their market cap. This means bigger companies are at the top, which is why I like the next part of this portfolio. But before we get into that, here's a quick word from Wealthfront. Wealthfront is a robo-advisor that helps you invest without having to do much on your end. The reason you're watching this video is that you're interested in how to construct a well-diversified portfolio that will eventually stand the test of time. Decades of data show that investing in a globally diversified portfolio of low-cost ETFs is a great way to put your savings to work. Wealthfront makes investing easy, affordable, and accessible no matter what your knowledge of finance is. Account setup is quick and easy. You simply need a few minutes and $500 to open an investment account, and Wealthfront takes care of the rest. Their annual advisory fee is 0.25% of your assets, but right now they will manage $5,000 of your money for free if you sign up with my link below. They offer a range of investment accounts such as taxable accounts and retirement accounts, such as a Roth IRA, for example. Now, let's take a look at a product demo that Wealthfront put together so I can show you all of what their clients are experiencing. The interface is super simple to understand and very well designed. Wealthfront makes it easy to see your cash, investments, and even liabilities. You can click into each one of these accounts and you can easily see your account history and performance. There are returns, dividends earned, estimated taxes, and pretty much everything that you need to know to view the pulse of your portfolio. You know that I'm a big proponent of ETFs, which Wealthfront has a large selection of. You can then select your risk tolerance and choose what investments you want to include in your portfolio. You can even choose the different types of categories of investments that you want to browse and put into your portfolio. There are different sectors investment strategies, social responsibility, commodities, and even cryptocurrency exposure. Or if you want to keep it simple, Wealthfront can build you a tailored portfolio based on your risk tolerance so you can set it and forget it. If hands-off investing is something you're interested in checking out, check out Wealthfront using my link, invest.wealthfront.com/Marco in the description below. Okay, the next 20% of this portfolio is small cap value, which I personally hold in one of my taxable accounts. Historically, small cap value has outperformed its large cap counterparts. If you want to get exposure to small caps, you might want to check out ticker symbol VIOV, which is Vanguard's Small Cap 600 Value ETF. There's also a newer fund from Advantist called AVUV, which I may or may not personally hold, which is their small cap value fund as well. These are all US based, so you may want to look at others for international exposure if that's important to you. But since I'm based in the United States, no other countries in the world exist, right? That was sarcasm. Please don't hit the dislike button. Oh wait, YouTube got rid of the number of dislikes on the video, so that doesn't really matter anymore. Dislike away, my international friends. So let's touch on short-term treasury bonds next, right here. So short-term T-bonds are essentially like keeping cash in your portfolio. If you've been following me for any period of time now, you'll know that I'm a huge advocate against keeping a large portion of your portfolio or net worth in cash. Savers are losers given the current interest rate environment, and I'm not a fan of this portion of the portfolio at all. If you're interested, however, in continuing with this portfolio, you may want to check out Vanguard's VGSH. This is their short-term treasury index fund ETF. In my opinion, cash should be used for offense and defense in your portfolio. It shouldn't just sit there. The defensive part is your emergency fund, for example, and the offensive part should be a war chest for opportunities that arise unexpectedly. Say the little old lady down the street passes away, you have cash in your war chest, you can buy her property for cheap, flip it, do whatever. So the next portion of this portfolio are long-term treasury bonds. These are typically part of your traditional risk parity portfolio, AKA the 60-40 equity to bond portfolio that all financial advisors usually roll with. The reason financial advisors have recommended this risk parity portfolio for so long is because bonds have typically been a hedge against stocks, okay? So, which is typically a good insurance plan for a stock market crash. So if you feel like we're ready for a crash, which many people do, then this may make sense to include in part of your portfolio. If you're looking for a long-term treasury index fund ETF, then Vanguard's VGLT may fit the bill for you. Historically, stocks and bonds have had an inverse relationship for the most part. So when stocks go up, bonds go down. When bonds go down, stocks go up. A lot of this has to do with interest rates and the health of the overall economy. And finally, the last 20% of this portfolio calls for allocation to gold. So now some of you may be salivating, the rest of you are probably cringing, and if you haven't clicked off of this video just yet, you're probably considering doing it right now. All joking aside, gold has historically been a great hedge against inflation, but if you look at its past performance, let's say over the last 10 years, compared to pretty much any other asset class other than commodities, you'll know that it's essentially been a joke and a yellow pet rock, okay? Even I have personally reallocated most of my gold position to Bitcoin because Bitcoin is digital gold and does everything gold is supposed to do, except way better and for the 21st century, if you will. So some of you may agree with that statement, some of you may disagree, but at the end of the day, I'll be riding off into the sunset in my Porsche 911 Turbo because of Bitcoin, but I digress. So whatever your feelings are about gold, you can't deny that historically it's been a great hedge against inflation. In Roman times, an ounce of gold would buy you a nice tunic. In modern times, an ounce of gold would buy you a nice suit. So I usually recommend buying gold directly as gold bullion, the physical metal. But if you want to keep this on paper through an ETF, then you can check out GLD or SGOL. In my opinion, buying a gold ETF is the same as buying a Bitcoin ETF. It defeats the purpose of owning the actual asset, but to each their own. If you are young, it may or may not make sense to own gold in your portfolio at this point, probably the former. But if you're an older investor and want to protect your wealth, then gold may be a viable choice. The next part of this video is actually going to be backtesting this portfolio. Since I use a website called Portfolio Visualizer to do this, Let's jump onto the laptop to show you these results.
Okay, so if you made it this far in the video, thank you so much. I really appreciate it. We're going to backtest this portfolio real quick, and then we'll wrap it up, and I'll give my opinion on how I feel about this portfolio in general. So if we go to portfoliovisualizer.com, you can actually backtest the portfolio using asset class allocation. This will hopefully get us to somewhere like in the 70s or 80s up until 2021 to see how this portfolio would have performed. Okay, so what we do right here is we're going to invest $10,000 and we're going to select these asset classes, and this portfolio is going to have 20% gold, which we talked about. So if we go down to commodities, here's gold. It's going to have 20% total stock market, okay? It's going to have 20% allocated to small cap value, okay? It's going to have 20% allocated to short-term bonds, fixed, where are we at? Short-term treasury, and then we're going to have 20% long-term treasury. Okay, so this is our portfolio right here. You can see 20%, 20%, 20%, 20%, 20% gives us 100, and we're going to compare this to a portfolio of 100%. Let's just do U.S. stock market. Actually, you know what? Let's do 100% of large cap, okay? And then we can do one against 100% against the total market. Okay, so we're going to compare these three portfolios side by side, okay? So what we see here, and the reason we backtest is so we can make informed decisions. This goes all the way back to essentially December of 77. So we're getting a pretty good sample size here, guys. So you can see there's portfolio 1, 2, and 3. I should have probably labeled these. But by far, actually not by far. These are portfolio 2 and 3 are essentially the same. Portfolio 3 is the highest at the end of this term, or at the end of this back test, at $1.47 million. That was our portfolio. That was just the U.S. Total stock market. If you remember, that's this one right here. Portfolio 3, 100% U.S. stock market, okay? So let's take a look at why someone would invest in this portfolio, even though it was by far the biggest loser. You're sitting at essentially half of the gains you would instead of just investing in the total U.S. stock market, okay? You're looking at $658,000 versus $1.47 million. So why would someone invest in this? So if you remember, I talked about in the beginning of this video that I don't agree with like 60% of the investments in this portfolio, and I probably wouldn't have them, especially in today's environment. But if you look at this, $10,000 invested would yield you these three yields, which we already covered. You can see this right here. This is the inflation-adjusted CAGR. You can see this is the biggest point right here that is the most interesting, that the best year was actually the highest in this golden butterfly portfolio out of the three, and by far the least worst year, the worst year, if you will, was -7% compared to 37%. So again, this max drawdown is 16.6% compared to 51% of the U.S. stock market and large caps, okay? So this is why people are interested in portfolios like this, because it has a lower correlation to the market. As you can see, these two are obviously 1-to-1 because it is the market. And you can see here that the worst year and the max drawdown is by far much less than the stock market. But what are you giving up in return to get those smaller maximum drawdowns? You're giving up basically 2x returns, okay? You're giving up basically 100% in gain, okay? So this was very eye-opening. I just wanted to show you this because you can see the annual returns right here. When the stock market was crashing 22% and 20% in 2002, this portfolio was actually up 3%. When the market was crashing 37% in 2008, this portfolio was down 7%. So I know a lot of people make fun of bonds. A lot of people make fun of gold, especially now, especially younger kids. If you've never been through a true recession, you know, you always think stocks go up forever, right? That's not always necessarily the case, but growth has dominated. Growth has dominated value in the recent 10 years, if you will, basically since 2008. So this is something that I wanted to show you because you have to backtest. You have to be open to other philosophies. You have to be open to other strategies. Is this something that I would invest in? Probably not. But at the end of the day, you know, the proof is in the pudding. Since 1977, you can see that the max drawdowns are significantly less compared to just investing in stocks. So I guess the point of this video is to show you that, you know, you should have some sort of diversification or a blend. If you're younger, if you're in your like 40s and younger, maybe even 50s and younger, it may not make sense to do this. You may want to start to adopt some of these philosophies when you do get older and want to preserve wealth as opposed to grow it. So as always, I hope you got value out of this video. I know this one's a little bit more long-winded, but if you stayed to the end, hit the like button. You are the true champion. Please share the video. You're the real MVP. I appreciate you. Thank you so much and have a prosperous day. 60% bonds and gold and treasuries. Yeah, hard pass. Hard pass for me right now. Buy Bitcoin. Peace.